I would say I'm most bullish on gold. I think only in the next month or two. I think gold is going to have that big run up. A nice rally here. I think gold percentage wise, based on the charts, actually has more to gain than silver does. Silver just had a big pop in the last couple of weeks. It actually just had a nice gain. Right now, I believe the lowest risk play is going to be gold to the upside. The stock market, I think, is on the cusp of stalling out and going sideways and not being a trade anymore for a little while. So I do like gold the best still. And if it starts to break out and run higher here, I mean, it's a great momentum trade for it to run up to about 4,000, 4,100.
Gold traders are at a pivotal juncture as the metal trades within a tightening channel, compressing between key support and resistance levels. This narrowing range sets the stage for a decisive move, either a breakout to new highs or a breakdown if momentum fails to hold. Chris Vermeulen, chief market strategist at the Technical Traders, remains optimistic. He notes that gold has been forming classic bullish flag patterns following each rally. If it breaks out from this current pattern, we could be looking at a target around $4,100 an ounce. He says, highlighting a potential 15 to 20% gain from current levels, a massive move for the yellow metal. Gold prices began the week on a strong note, reaching one-month highs in most major currencies. A weakening US dollar fueled the surge after dovish comments from a Federal Reserve official and ahead of President Trump's August 1st tariff deadline. According to Bullion Vault, spot gold rose for the third consecutive week, climbing 1.1% by Monday lunchtime in London to $3,387 per troy ounce, the highest since June 24th. The looming implementation of broad U.S. tariffs, ranging from 15 to 20% on European imports, has triggered cautious behavior across financial markets. While S&P 500 earnings remain strong with an 83% beat rate, equity markets are showing signs of hesitation, with recent highs beginning to fade. Vermeulen draws parallels between the current setup and the conditions seen in 2007, when stocks were at record highs, the dollar was weakening, and gold was surging. He believes gold still offers the best near-term opportunity. It's had a steady run, he says, but it hasn't exploded yet like silver just did. Make sure to tune in for our expert analysis. Don't miss out on future content, hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Yeah, so gold's got lots of potential still. It's been trying to figure out if it's going to put in a top and roll over, but in the grand scheme of things, if we look at price action, we've seen a series of flag pulls in price trading sideways, where price rallies up and then flags, and it's been consolidating. It has a very strong chart pattern here, pointing to about 4,100 an ounce if it does break to the upside. So there's actually quite a bit of upside potential here for gold. I really like it percentage-wise. It is a significant move based on even where it is today after its nice rally. There's about a 15-20% upside move in gold, which would be a huge explosive move. And that kind of coincides, which I shared with you once before. These two charts here. The yellow line is gold. The one on the left is 2007 S&P 500 stock market top. So the candlestick chart is the S&P 500. The one on the right is today, the current price action. So what's really interesting is the stock market had a pullback and a rally, and then it broke to some new all-time highs. And gold was trading at all-time highs, and it was the number one kind of top performing asset class. Well, we have the same thing happening right now. The stock market has just pushed to all-time highs. Gold is trading in a big bullish pattern. It's one of the top performing assets, and everybody wants it. And then, of course, if we were to actually look at the chart of the dollar, let's go back to 2007 chart and look at what the dollar does. This is the green line. As you just mentioned, David, it's been beat up. It's struggling. It's down today. And more or less back in 2007, nobody wanted the dollar. It was beat up and it had gone straight down. Well, if we look at today's chart where gold is and the stock index and the dollar is crashed as well. It's beat up. Nobody wants it. And everybody's moving into gold and stocks. So we have a very similar chart pattern set up. Different reasons for why it's all happening. But price only goes up or down based on fear and greed. And the charts, that's why I like to look at the charts, to get rid of all the noise, all the news, all the opinions, and just look at price. And either people are bullish for whatever the reason is, or they're bearish. They're buying or selling. And so this chart pattern is setting up pretty interesting. The big scenario, which I've been talking about for a long time, is what happens after this scenario plays out. Now, initially, if we look at the chart on the right edge, you'll notice stock market starts to fall. Gold starts to move higher and really takes off for that big push. And I think with gold could have one more big push to 4,100. Eventually, the weight of the stock market moving down will turn bearish and people will start to dump everything, force liquidation. Gold will start to pull back. And if we just keep rolling forward here, you can see how the stock market fell over 50%. Gold got pulled down temporarily, but I believe we're coming into something like this in the stock market. And that's what we need to be aware of. And whether it happens or not, it doesn't really matter, but you definitely need a plan if it does happen. Because if you don't, you're going to really annihilate your retirement, your lifestyle, because all this can happen in like a year, less than a year, and your whole life get turned upside down and your whole life savings can be cut in half. So that's what I'm always talking. That's why I'm always have a bit of a bearish bias. I'm like, you better have a game plan because it's just a matter of time before you kill your retirement. And if the markets keep going higher like they have been, we still use a strategy to follow price higher. So we keep growing our accounts, even if it goes against the bearish outlook that I have. So hopefully everybody can keep up with all those squiggly lines and what I'm talking about. I would say I'm most bullish on gold. I think only in the next month or two, I think gold is going to have that big run up. A nice rally here. I think gold percentage wise, based on the charts, actually has more to gain than silver does. Silver just had a big pop in the last couple of weeks. It actually just had a nice gain. Right now, I believe the lowest risk play is going to be gold to the upside. The stock market, I think, is on the cusp of stalling out and going sideways and not being a trade anymore for a little while. So I do like gold the best still. And if it starts to break out and run higher here, I mean, it's a great momentum trade for it to run up to about 4,000, 4,100.
Wall Street closed mixed on Monday as the Dow Jones Industrial Average slipped 0.04%. While the S&P 500 gained 0.14% and the Nasdaq Composite rose 0.38%. Despite modest movements, traders remain cautious as markets hover near all-time highs, with technical signals suggesting a potential shift in momentum. Chris Vermeulen, chief market strategist at the Technical Traders, advises caution for investors holding long positions in indices like the Nasdaq and S&P 500. He notes that historically, after a 15% gain following a trend reversal, the Nasdaq tends to either correct or enter a prolonged consolidation phase. This is usually the point where tightening your strategy is essential, Vermeulen says, hinting at a possible pause in the market's upward trajectory. Still, major Wall Street firms remain broadly optimistic. Morgan Stanley now leans toward its bullish case, forecasting that the S&P 500 could reach 7,200 points by mid-2026. This is a substantial upgrade from its earlier projection of 6,500 in the second quarter of that year. Equity strategists, led by Michael Wilson, argue that with corporate earnings showing resilience and the Federal Reserve approaching a phase of rate cuts, current high valuations, approximately 22 times earnings, are sustainable over the next 12 months. Echoing the sentiment, Jefferies has also raised its year-end target for the S&P 500 to 5,600, up from its prior forecast of 5,300. The consensus among these firms is that while near-term volatility may persist, broader economic and policy trends continue to support equity valuations. Let's get back to the interview.
They're continuing to grind and scream higher. We had the S&P 500 breakout. We had the Nasdaq broke out first, and money's really kind of piling into this market. We went from an oversold bounce. It looked like it was going to be a dead cat bounce, and then it really came to life. It turned into a big rally, and here we are at all-time highs. So it just goes to show you really do have to be dynamic. A lot of people get stuck on you say something, and then people hold you to it as the market changes, and so does the analysis, and it goes from a bounce to a rally to now new all-time highs. You really do have to pivot and shift. You can't hold a thought in your head when it comes to this market. You do have to bend to its will and follow it. So the markets are at a really critical turning point. I mentioned to you just off camera here, there's a couple different camps that are suffering right now from all-time highs being hit kind of week after week, which are the camp of people who are very nervous. They think a big bear market is coming like I do. And they were too nervous to get into the market even when the trend turned up. And so there's a lot of people missing out. The FOMO is very high. I have what I call an inbox indicator. Pretty much we get a good gauge of how people are thinking and feeling and what they're doing with their money or not doing with their money. And people are very frustrated if you're not long this market. And there's a lot of people who miss this rally. The other half are all the people that thought it was going to sell off and they were more aggressive and they bought inverse ETFs or they bought put options that just keep falling in value. And so both camps are suffering quite a bit. And as I think, a lot of studies show, FOMO, missing out on a gain, is more powerful than actually taking a gain. So every time these markets push to a new high, just like they are today, as you and I are talking, and it's doing it with some power today, there's a lot of pain going on in the markets for, I would say, the majority of aggressive traders or self-directed traders who just don't have a position or are on the wrong side.
Tell us about the technical indicators you're looking at that could indicate a reversal of this trend.
Yeah, sure. I mean, if we pull up the chart, there's a few interesting things going on right now in the charts on a short-term basis. Let's just take a look at the put call ratio. Now, this is a really messy looking chart, and long story short, there's this little 5-day moving average in the background. And in a nutshell, whenever the 5-day moving average gets down into this lower level that it's hit 4 times in the last month and a half, 2 months, the market tends to stall out. And right now, everybody is very bullish. People are buying call options. They're betting on the markets going higher. So this is a really good short-term indicator. This is telling us, hey, we're probably going to see the market have a bit of a pause or pullback. The other thing that we can look at here is our panic selling and our FOMO indicator. When we look over here, we have this indicator reaching 3, this red indicator. Whenever it reaches one of these levels, we tend to see a short-term pullback in the market. So for example, we got 3 on this indicator, usually means the market's going to want to have a bit of a pullback. We got up to this 3 level over here, the market had a little bit of a pullback. Now these are very short-term signals. It happens over and over again in the market. But what's really interesting, David, is when we go and we look at our sentiment of this market, and this right daily chart of the QQQ, we've color-coded it based on sentiment, what people are thinking and doing. And during an uptrend, typically people get bearish and we get these yellow bars just before the market actually shoots higher. So people get bearish. They think the market's going lower after the big low here after the April sell-off. But the market goes the opposite direction. People get nervous. They decide, okay, market is rolled over. It's going to go down. And then it goes the opposite direction. What's interesting right now is we actually have the market pushing to all-time highs. It's not after a bit of a pullback in fear. And if we actually zoom out and see what happens in a downtrend, we actually tend to see this happen near a peak, and then the market actually starts to sell off. So we have a couple of interesting things unfolding. I'm not saying to bet against the market. I'm not saying it's going to fall right now, right away, but we do have to be aware that if you are in a position, which we were long the NASDAQ, we closed out at 15% last week. We're still long the S&P 500, but just be aware, we are getting very close. Almost every time the NASDAQ hits a 15% target after one of our trend changes from a bounce to a trend, the market generally will go into a big multi-week or multi-month correction. It might go sideways, it might not pull back a lot, but it will become noisy. And so that's what we're waiting for. And that's what the short-term charts are also pointing to. So those are the things that we're just kind of looking.
Compressed ranges rarely stay quiet for long, especially when they coincide with macro crosscurrents like equity fatigue, dollar weakness, and growing geopolitical tension. Gold's restrained yet consistent climb hints at a market coiling for something bigger as traders weigh conflicting signals, strong corporate earnings on one side and monetary uncertainty on the other. Meanwhile, technical indicators suggest that momentum is building beneath the surface, setting the stage for a move that could surprise even seasoned market watchers. As risk appetite wavers in traditional equities, the gravitational pull of hard assets may begin to assert itself with renewed force. Is the current calm in gold simply the quiet before a storm, one that could redefine safe haven dynamics in a world rethinking both growth and value? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.